Is this an area that has still got opportunity, or has it just gotten too expensive given all of the investor attention over the last, call it, year?
Well, when you say this area, I'm presuming we're continuing with Brian's forecast about small cap stocks looking relatively attractive. I think certainly from a momentum perspective, from the thought that they peaked in the latter part of 2021 and experienced their own bear market well ahead of large cap stocks. So I think, they're trading at valuations that do look relatively attractive. I think, however, that because of the market's response to yesterday's Fed decision, if you will, not to sound as dovish as the market had been anticipating, we're still going to be looking for those areas in the defensive and inflation hedge areas that are likely to do relatively well. So staples, healthcare, utilities from the defensive perspective, but then also energy from the inflation side.
Could I just bring you back to the small cap conversation, only because we kind of opened the door for it right there, Sam? The conventional wisdom had been in the past that when you have a forecast for what could be a market economic downturn, it is the large cap stocks that tend to do better because their balance sheets are stronger. They can hold up better in an economic downturn. Smaller capitalization names don't do as well because they're more exposed to economic cycles than large caps are. Why the outperformance right now, and why do you think small caps could possibly outperform given this inflation and recession narrative over the next 6 to 12 months and beyond?
Well, I think, Dominic, as we see today, the market really is not continuing its nosedive that it incurred yesterday. And I think that what is happening is that ourselves included, a lot of economists are projecting that the Fed probably will go to a 50 basis point hike in December from the 75 basis point expectation. Also, as we enter 2023, we'll probably have another 50 hike and followed by 25, with then the Fed looking to pause and then pivot by lowering rates late in the second half of next year. So I think investors are beginning to look across the valley. They're looking at those areas that will likely benefit from the pause, then pivot by the Fed. And I think the mid and small cap area is what's garnering attention.
We're not seeing a follow through today, as you point out, from yesterday's big sell off. Does that mean in your mind, Sam, that the bottom is in?
I think the 3,500 level appears to be the bottom, at least in the near term. Expectations are that, you could look at from a technical perspective, that is the target from the head and shoulders pattern that developed earlier this year. Also looking at PE ratio declines on average during bear markets, et cetera. So I think that line in the sand is the 3,500 level. We're also in the best 6 months of the year from a seasonal perspective. And so as a result, we probably could see some encouragement, some seasonal optimism kick in between now and year end and early in the new year.
The regular seasonal optimism is always at play during the fourth quarter of any calendar year. But this year is also somewhat different. It's a midterm election year. There are seasonal aspects and tendencies to that as well. How much do the elections coming up next week affect the way that you are looking at how the markets are valued right now?
Well, Dominic, historically, the fourth quarter of the midterm election year is the second strongest in terms of average price change, up 6.4% since World War II, and frequency of advance, 84% positive. And if you look to the first quarter of the year after, so first quarter of 2023, average gain is 6.9% and a frequency of advance at almost 90% of the time. So even depending on whether you are looking at a change to the House or the House and the Senate, historically, 12 months after the October 31 date of the midterm election year, market has been higher 100% of the time, and the average total return was 21%.
All right, Sam, before we let you go, just a few moments left here. 10-year yields are at 4.2%. Two-year yields, risk-free money at 4.7%. Are bonds attractive right now?
I think they are. We probably will see a little creeping higher with the 10-year, but then our belief is that we will be ending 2023 lower than we ended 2022.